Welcome back to Rockstock Channel. It is Friday, December 12th, and we're here with Rodney, Matt, and our good friend, Keith Phillips, who has quickly come out of retirement following the Sayona-Piedmont merger, which formed Alevra, to join the board of Q2 Metals and share his thoughts as this year is quickly coming to a close. But before we start, I just want to say thank you to all our viewers and followers on YouTube and Spotify, LinkedIn, and X, and elsewhere, for all your support and input about the white paper about the Strategic Lithium Reserve that I put out earlier this week. The debate around the SLR has been quite incredible. Smart questions, sharp critiques, genuine engagement from professionals across the sector, which is exactly what we need. Every single issue we talk about in critical minerals, permitting, investment, reshoring, defending supply chain, it all comes down to one thing: price. SAFE, which had a summit earlier this week on Tuesday, basically said the same. The whole topic of the summit was that price is the fulcrum. If a price collapses every few years, nothing gets built, period. I was in Washington yesterday at the CSIS event, which also is heavily focused on price, as price floors is very much a topic in Washington, among other things. China figured this out early. When they launched the G-FEX in 2023, pricing power shifted overnight from Western producers to Chinese buyers. CATL, BYD, and the converters. Lithium, as I've said in my Lithium Bowl over the past couple of years, went from an oligopoly where SQM and Albemarle and the former FMC was an oligopoly. It's now an oligopsony led by CATL, BYD, with the G-FEX being an instrument for their buyer power. So prices are no longer set by Albemarle and SQM. They're set in China on a platform designed to serve Chinese industrial policy. That's a choke point, and that's what the Strategic Lithium Reserve fixes. The SLR isn't about moving the whole global market. It's about taking away the catastrophic lows, the 7,000, 10,000 carbonate price that kill Western investment. A rules-based SLR buys as much as needed, maybe 150,000 tons next year, to re-anchor the market at a sustainable $20,000 to $25,000 incentive price. After that, the system stabilizes and annual buying drops dramatically. And here's the real beauty. This isn't a subsidy for picking winners or losers. If you're a fourth quartile, high-cost project, the SLR does nothing for you. The floor is high enough to enable competitive projects, but not so high that we keep uneconomic assets alive. The reserve simply prevents China from choosing the losers. And let's talk upside. The SLR isn't just about security, it's about opportunity. The U.S. can become the world's leading exporter of refined lithium chemicals, just like we did in oil and gas over the next 10 years. Smack over DLE could result in, unconventional oil shale moment. Maybe Nevada too. Let allied brines and spodumene from Canada, Argentina, Brazil, Australia flow into American conversion. Let private markets decide the geology, but let the U.S. own the midstream. That's how America becomes an electrostate. We're already a petrostate, but the electrostate, we need to mirror what China's doing. China's already has energy dominance across, the electro supply chain. Lithium dominance is built on scale, technology, and a stabilizing public institution that restores price integrity to a market China has distorted. This is not the only policy the U.S. needs, but it is the first, fastest, cheapest, and fairest step, the one that unlocks everything else. So thanks again for being part of the debate. We're going to put the 5-minute video in connection with the SLR at the end of this video. And now we're going to move on after thanking our sponsors. Lithium Royalty Corp, traded on the Toronto Stock Exchange, ticker symbol LIRC, and holds more than 30 royalties on hard rock and brine projects, such as Core Lithium in Australia, Sigma Lithium in Brazil, and TradeQ in Mariana, owned by Zijin and Ganfeng in Argentina. And USCF Investments, a pioneer in commodity ETFs for nearly 20 years. Their 15 funds include single commodity exposure, broad diversification with SDCI, and themes like ZSB for battery metals and USG for gold with income. To find out more, watch our inaugural episode with their CEO, John Love, and visit uscfinvestments.com. And with that, welcome back, Keith. You've been on the podcast a number of times as Piedmont Lithium. And Matt, Rodney, I'm going to let you kind of lead this because I've been very heavily focused on this Strategic Lithium Reserve this week. What else happened? And can dig in from there.
Okay, thanks, Howard. Well, maybe I'll kick off. Let's start in China. Obviously, we're expecting the CATL lithium mine to restart this week. Hasn't restarted. Question for Rodney and Keith. What happens if it doesn't restart? Where do you see lithium prices going in the near term and the medium term? Who wants to take that hospital path?
Keith,
that's nicer than most of the questions you give me, Rodney.
Yeah, right. Matt, I think that the price structure was baking in that restarting. So my sense would be that we should see a move above 100,000 renminbi on that news. And then we'll take it from there. We'll get into some other discussions because you've had some interesting takes on estimates on demand, and that will play out. But I think short term, I would say it should assist the market in going up over 100,000. And interesting to see the G-FEX has gone back into contango, not steep, but still there. So the expectation now is higher prices in the future. Keith, your thoughts?
Well, less supply should mean higher prices. So if that is delayed, that'd be a good thing for the market. I think ultimately the demand growth is going to be strong enough that it won't have, and as the market gets bigger, I think that individual asset will have a less significant impact on price going forward.
Yeah, I mean, I think it's a really interesting question because historically over the last 4 or 5 years, the lithium price has been quite seasonal, and that's off the back of the very strong EV selling season in October and November in China. But we are sort of transitioning away from EVs being the major driver of the market, and ESS cell production is still very strong at the moment. So the big question is, does that sort of take out some of the seasonality in the market over the next couple of months, or do the seasonal trends exert themselves, I guess, is the question. Okay. So moving on, quite interesting data points coming out of the Chinese market over the last couple of weeks that we may not have sort of picked up on. I think one of the really interesting things is that NIO seems to have dropped its semi-solid battery in China because of a lack of demand. Now, they didn't say as such, but that seems to be related to price. And if that's the case, what does that say about the viability of solid state sort of taking over market share from lithium ion over the next sort of 5, 6, 7 years?
I guess the question, Matt, is answer a question with a question is, what are the benefits of that format relative to what we have now? Is there any huge range differential? Look what's happening now with some of the top models. So explain to me, when solid state first became a topic of conversation, the performance metrics and the energy densities and so on were still evolving, but now we've got models that can drive 1,000 Ks and what have you. So what is explain to me the perk of solid state now, if it's more expensive.
This was a semi-solid state battery, so it wasn't all the way to solid state, but it was a 150 kilowatt hour battery compared to their normal battery, which is a 75 kilowatt hour battery. So you had a more expensive battery, which potentially had a substantially higher range because it had higher energy density. And it seems that only had like a 2% take up on their platform, while most people wanted to stick with the sort of 75 to 100 kilowatt hour battery, which is cheaper and gives a sort of balanced range performance delivery, as it were.
Matt, as I recall, I haven't looked at solid state in a while, and I've never thought about semi-solid state. I'm not sure I know what that means. Maybe you can explain it to me. But the other advantage was going to be charging speed. As I recall, range would be considerably larger, but charging speed would be dramatically faster, which I think could be, as a Tesla driver, I love my car, but on the long trips, sitting 20, 25, 30 minutes periodically, it'd be great if you could shrink that. Is that still the opportunity with solid state?
Well, I mean, charging speeds have improved, but obviously the big issue with charging speeds is not just the battery, it's also the charging infrastructure. So if your charging infrastructure isn't powerful enough to interface with a battery that can take higher charging, you're still stuck with a slow charge. But yeah, so the point about solid state is really energy density. And there are some batteries in the market, even some LFP batteries in the market now that can charge in 5 to 10 minutes. So they're very fast charging. So I don't think the fast charging ability in solid state is, certainly by the time it comes into the commercial market by 2030, going to be a huge selling point. But the key selling point is energy density. But obviously there are other questions there, like cyclicality and aspects like that. But I mean, my takeaway is that consumers are still quite price aware, basically, and it seems that beyond a certain level of energy density, i.e. range, they're not willing to pay up for a higher spec battery. And if that's the case, then you do wonder whether solid state, when it comes in, is going to take significant market share away from lithium-ion, particularly given the improvements in lithium-ion technology that we've seen over the last sort of 3 to 5 years or so. Cool. BNEF battery survey out this week. Really interesting survey. I remember when I sort of first got into the space in sort of 2017, 2018, battery costs were around about sort of $250, $300 a kilowatt hour. We're now down to $108 a kilowatt hour on average. And I think BNEF are saying that some energy storage batteries are as low as $70 a kilowatt hour. Which compares with, I think the number was $1,400 or $1,500 a kilowatt hour in 2010. So, I mean, it really has been an amazing sort of technological advancement in the industry over the last, 15 years?
Yeah, look, I think, Matt, that's excellent going. I guess the question now is the question of the law of diminishing costs with doubling of production. The question now is, if all else being equal in terms of material costs, can we see much of a reduction in battery prices from here, or we're about to stagnate, level off? Just to be clear, I think at these prices, in terms of growth in energy storage and EV penetration, bodes well, but I guess how much more give is there in terms of scalability and improvement around how the cell is structured and being able to lower from here without material costs is, I think, key.
Yeah, I mean, that's a $64,000 question, and I mean, I called the recovery in raw material prices too early and was quite disparaging about Bloomberg's analysis. I think it was 18 months to 2 years ago. I said, there's no way you're going to lower costs if raw material prices go up. And of course, raw material prices went down. They only went in one direction. So, so, I mean, I think the key question is, obviously, if lithium prices are starting to increase now, what's that going to do to battery costs over the next couple of years? Do they flatten off? Can they continue to go down, or do they start to go up? And then obviously, if they start to go up, where's the pinch point, which starts to push things like ESS into sort of negative sort of economic situation? And if that does happen, does that mean then we move into competing technologies like sodium ion and flow batteries. So I think those are the big questions, to be honest. I personally do not have answers to those questions, but those are the questions that we need the sort of answers to.
So, well, you had an interesting article in the Battery Materials Review about the underestimating of lithium demand and then the overestimation. I think the overestimation is the interesting one here, Matt. The question of lithium intensity. I have been wondering, as time has gone on, if you can just flesh out your thoughts about the overestimation that we're seeing in the market.
Yeah, so I think there's really two factors at play here, and I sort of haven't brought this up before now because I felt that brokers were naturally understating lithium demand because they were understating ESS forecasts quite structurally. But now brokers are starting to raise ESS forecasts. I think it's important that we're all sort of singing off the same hymn sheet, as it were. So what I'm talking about here is the lithium loading in the battery, so in grams per kilowatt hour. And depending on the technology of the battery, there are different lithium loadings. So if you look at sort of industry consultants like SMM and Benchmark, they've got a much lower loading for lithium in LFP batteries, probably around about 600 to 700 grams a kilowatt hour. And then mid-nickel batteries, interestingly, have a very, very high loading, around about 900 grams a kilowatt hour. And obviously you can tell that's a 50% difference. And what we see is a lot of the broker reports that have come out over the last couple of weeks or last couple of months or so have very, very high loadings on average for the market. So they're implying that basically the market is using mid-nickel or high nickel batteries for 100% of production. And as we know, LFP batteries dominate in ESS and probably are 40 to 50% of the market in EVs. So what I'm saying is a lot of the brokers are overstating structurally the amount of lithium that's being used for every gigawatt hour of batteries that's going into the market. And I think it's really important that we get these assumptions right, because structurally over forecasting demand in the market is just as dangerous for companies as structurally under forecasting demand in the market.
Yeah, so that's a good one. It's interesting. I've always used about 0.6 of a kilo in LFP as my estimate. So and then the other thing that you raised, Matt, is, what percentage of the market is whatever large size SUVs and so on? What is the average size of the battery? Now, I'd adjusted my models down a while ago, given that China's been dominating the EV market. So your thoughts about, these forecasts that are having material growth going out to 2030 and beyond for average battery size?
Yeah, to tell you the truth, this was the first thing that sort of flagged as an issue when the flurry of upgrade reports came out in the summer. And I've been doing some work on it over the last sort of 3 or 4 months or so. And it's entirely focused on the EV side of the market. So it's not in the ESS side at all. But one of the key points is that, I think there is a perception in the market that the average size of an EV battery is about 60 to 70 kilowatt hours at the moment. And it's not. It's considerably lower than that at the moment. And, there is a perception among many analysts and consultants that the average EV battery size will increase substantially over time, potentially by as much as 30 to 40% over the next 5 years. But my contention is it may very well not do so. And if you look at what is mass market in passenger vehicles, so not including EVs, just all passenger vehicles, you'll see that 50% of passenger vehicles that are sold in the world are small cars and small SUVs. So cheaper vehicles, smaller batteries. So it really comes back to this issue of what is mass market. And at the moment, mass market in EVs is large cars and large SUVs. But as we move towards mass market and we look at affordability in different countries, does mass market in EVs genuinely look like large cars and less large SUVs? Or does it look like more affordable vehicles with smaller batteries? And there's no, the reason that China, on average, has much smaller batteries in its EVs, in my view, is primarily because EVs in China are mass market. So in China, you're seeing smaller batteries because people are focusing on affordability in electric vehicles rather than necessarily size and range. And I think as we tend towards mass market, we are seeing, a lot of I've got the numbers in BMR, but a lot of the brokers, I think, potentially are overestimating the EV battery size. And, when I say these things, it sounds like I'm bearish on lithium, but I'm not actually bearish on lithium. I'm bullish on lithium. I see 16% per annum growth in demand for lithium over the next 5 to 10 years. And I see, the potential to increase those forecasts when I sit down at the end of the year and go through the ESS numbers again. So, I'm pretty bullish on lithium, but I'm not like table thumpingly, oh my God, we're going back to $80 a kilo next year because demand's going to be so amazing on lithium. I think it's really important to differentiate and to just make sure that our assumptions are not crazy scary on the upside.
I guess to some extent, Matt, is the slower uptake in the US, where there were going to be materially bigger battery packs in EVs causing a sort of a slight downtick as we have it now. I see it's minus 1% for the year, the latest numbers. So I think that's playing a role.
Yeah, I think the last 2 or 3 years have been really interesting because the rate of growth of battery size has actually slowed in 2024. And the reason that happened, in my view, and there's no absolutes in this market, we don't really know, but the reason that happened in my view is because we saw the plug-in hybrids very, very strong in China. But plug-in hybrids have lost market share in China this year. But certainly the weakness in the US market, the strength in the rest of the world market, which is using a lot of Chinese vehicles, potentially is one of the reasons why the growth in battery sizes has slowed.
Hey Matt, has Tesla said anything about battery size for the robo-taxis they're going to make? Those will be modest sized vehicles, I think, right? But I would think they would want to have decent sized batteries if they're going to be on the road a lot.
I haven't seen anything on the Tesla. I don't follow Tesla in intimate detail. So Howard, have you seen anything on the robotaxis?
I not on that question. I do just remember in the Q3 call, him talking about like 2026 being a year for significant ramp up of production volume generally, of cars, as well as, mega packs for energy storage. So, fingers crossed. As I've mentioned, I'm a Tesla owner now for 4 months or 5 months. And as you saw, Matt, when you were here, I'm using full self-driving, 90% of the time. So I've become a believer in autonomy, and I'm also, I see statistics like Waymo drives, et cetera. So it's coming.
Apparently they're going to switch it on in Europe next year. So that's quite exciting because that's been a region where they haven't been able to use autonomous driving up till now. So I think that would be quite positive for demand going forward as well.
If I could just switch topics, I was a little bit distracted because I actually, Lithium Royalty, Ernie Ortiz, pinged me that Power Metals reached a cesium concentrate offtake agreement with Albemarle. So Power Metals, which we featured on this podcast many times this year, they've been pretty much quiet for the last kind of 6 or 9 months because they told the market they were going to do a deal, and deals take time. So the deal that was announced is that Winsome Resources, which owns 100% of the offtake rights. So Winsome's giving the offtake rights to Albemarle, but retaining their 15+% stake in it. And Albemarle is giving $5 million prepay to Power Metals in 2 tranches, $2 million up front and then $3 million upon delivery of a permit, basically. So anyway, just a deal here. I got distracted, but a number of our viewers have watched the success of Power Metals as well as Winsome. I don't think this is the reason. I don't know if this is the reason, but I don't think this is the reason that Winsome's in trading halt. But hopefully over the weekend we'll have some sense on that. But let's use that as a segue, Keith, to talk about Quebec and your recent appointment as a director, of Q2 Metals. So what attracted you to come out of retirement, I guess, or like, what are your, just give us an update since you left Alevra and now having joined, Q2.
So still very much in retirement, although I was just reflecting on that while listening to the conversation. It's only been 3.5 months. It actually feels like 3.5 years that I've been out of that job. It was a very intense last few years through the downturn. Q2 is just a very exciting story, and you and I have talked about it in the past. I was following the drill results while I was at Piedmont, and I was just amazed. There's really no other word for it. And I started to follow it a little more closely, had some conversations with them. And I think it's really exciting. It's we've seen exciting exploration successes in Canada, stories you guys are familiar with, PMET, Frontier, Mobilan at Alevra, et cetera, others. But I think Q2 is potentially, by far the biggest. I think it's going to be, they haven't declared a resource yet, but I think the exploration target's actually obviously very significant in size. I think it's going to be big and get bigger. The grade's going to be really good. And location matters a lot in Quebec. Obviously at Piedmont and with Alevra, you have the North American Lithium Project, which isn't the best ore body in Quebec, but it's probably the best located. It's 40 miles from rail. Some of the other projects in Quebec, as you know, are a long distance from the market, and that's a challenge for all kinds of reasons. It's a challenge economically from a cost perspective. It's arguably a challenge environmentally. Winters are long and cold and snowy in northern Quebec. Q2's Cisco project is pretty well located, relative, certainly considerably better located than some of the other projects up in the north. That's a big advantage. So I'm excited about it. I'm an outside director, independent. It's a relatively low time commitment, but it's fun to be involved. It's an exciting story. I think it's a very strategic asset. I think Quebec spodumene is going to be an important player in the industry. I think Q2 could be at the center of that. So I'm very excited.
That sounds great. And we had Rio Tinto had their strategy day, and then they had, their Argentina day. But I was a little bit worried after they left Yadar. What might it mean for Bécancour? And just for clarity, that they're definitely going ahead with Bécancour conversion. But they're going to choose between Galaxy and Whabouchi. My betting and intelligence is very much that they will choose Galaxy, much larger deposit, but that is way up north, I think, right? Where less well located than some of the things you were just addressing.
Yeah, I'm not as close to it, but yeah, it's bigger. It's I don't think it's quite as well located as Whabouchi, but it is bigger and it's 100% owned, I think, whereas Whabouchi is not, and that's an issue. It's always difficult to deal with a joint venture partner. It may particularly be if that partner is the government. I don't know. I've never dealt with them directly in that way, but I think it's interesting. I'm excited that they're sticking with Bécancour. I'm not surprised by that. I hope they do a good job with that. And if it works well, there's an opportunity for them to double down and quadruple down. We need a lot of conversion capacity in North America. Quebec's a logical place for some of that. Rio Tinto's, they're very capable financially and technically. So I'm pretty excited about that. And then the question is going to be, where do they get the spodumene in the very long term? And there's some prominent assets in Quebec that I think probably just never get built, particularly when there's a discovery like Cisco at Q2, which is so much bigger and better located than some. With the permitting timelines accelerating in Canada, it appears. I think you can see projects move a little more quickly. And while Cisco's in early days, pre-resource, I think you can get from resource to DFS actually pretty quickly and hopefully through the permitting timelines pretty quickly. So as people think about where to deploy capital, I think that becomes a pretty core asset for people to think about.
Keith, people obviously talk about how long it took for Galaxy to get their permit through the pandemic and everything. Do you think that the permitting timelines are going to be significantly accelerated in terms of what they have been for the new projects?
I hope so. The Minister of Natural Resources in Canada, federally, is an old friend of mine. We worked together at Goldman 25 plus years ago. Very capable guy. He's been very clear that that's a priority federally. And I think he's the kind of guy that makes stuff happen. And I think provincially, you've seen something similar. There was an announcement, I think, this week about permitting timelines being cut in half in Quebec. That's a commitment, I believe, from the government. That'd be a huge move forward. Timelines, Quebec's a great mining jurisdiction. Canada's a great mining jurisdiction, but permitting timelines have been relatively long. So fixing that to big strategic priority, I think, for that nation and the province, and it just perfectly plays into the hands of a project like Cisco.
And I mean, you've been obviously CEO of a lithium developer. You're now sort of slightly out of that. Can I ask how you think about sort of investing in lithium projects? I mean, what are you obviously covered a lot of the things that you look at with regards to what you said about Cisco, but what do you think about a new lithium project when you look at it in terms of how to invest? What are the key things that you're looking at for that?
Yeah, it's a really good question, and I think my perspective changed quite a bit through the market. We had a really strong bull market for 2+ years, and then a really deep bear market for 2+ years. And in the depths of the bear market, as Howard indicated earlier, nothing was getting built. Very few things were being advanced. Everybody was preserving capital. 3, 4, 5 years ago, the opposite was true. Everybody was moving kind of as quickly as they can. So I think for, as a run-of-the-mill mining project, I think, capital efficiency matters. And the overall economics of the project matters. But every project's very unique from both geologically, but also from a location perspective, whether it's political risk, proximity to markets. It's really interesting. You think about North Carolina versus Quebec, for example. I mean, North Carolina is not thought of as a traditional mining powerhouse, but the location is really quite exceptional for access to market, access to people, power, infrastructure. It's all right there. So it'll be interesting to see how that evolves. Obviously, the U.S. government should be very supportive of things in a place like that. And then putting kind of the funding package together and being able to fund projects at the right time. It's not a great analogy, but I remember an analogy that was drawn about a decade ago by the CEO of one of the two big gold developers in Canada. I think it was Cisco, contrasting the Cisco projects with the Detour projects, Detour Gold. And Cisco was able to raise money at better times and suffer far less dilution than at the time. This is ancient history, Detour. So how you fund a project, when you fund it, whether you're funding from a position of strength or not, I think can make a big difference. Ultimately, I think we're in a world now where, compared to when I joined the lithium business in the summer of 2017, most of the projects people talk about now didn't exist. They weren't a glimmer in anyone's eye back then. PMET, Cisco, Moblin was sort of around, but not really around. Azure, some of the projects in Brazil, et cetera. So now the world's awash in projects. It's gonna be really interesting to see which get developed and how they get funded, and it's gonna be really interesting. And for companies that have choices, like a Rio Tinto, it's really interesting. Whabouchi might compare favorably to some other projects in Quebec, but if it doesn't compare favorably to Galaxy, it's not going to get built. Levra has 4 projects. So it'll be really interesting to see. I'm not privy at all to how they're thinking about strategy now, but it'll be, it's pretty clear to me that the expansion of North American lithium is probably the best capital project in the spodumene business, maybe anywhere. The opportunity to take operating costs down $100 or so a ton, on that site with a very large resource is pretty important. So I'm excited for them to be able to capitalize on that. What they do after that, it's kind of different politics, different resource sizes, different funding opportunities. It's a challenge.
It'll be interesting to see if, my understanding is that Rio's, the Bécancour is relatively advanced, right? But Galaxy is not so advanced. They need to build that. So could North American Lithium supply Bécancour, for a period of time, and with Tesla in Texas, right? North American Lithium suddenly have, two places to sell in our hemisphere, so that they don't also lose on the shipping cost. So that's to be determined. But I'm curious, Keith. So you lived that, right? Just so I want to dig in a little bit, just like your perspectives of your OEM relationships. You had Tesla and LG as offtake partners. So how has their thinking evolved over time? And then how did you navigate those versus you were also selling, into the spot market, through traders, right? So just moving material physically, spodumene as the only company doing that, right, in this hemisphere. It'd just be interesting to hear any color you could provide on that topic.
Yeah, no, interesting. When I, in the early days at Piedmont, when I would travel around the world to see investors, particularly in Australia, the first question was always, where are you? Or one of the first questions, where are you with offtake? And I think offtake in the early lithium days was very much viewed as a point of validation. And if you don't have an offtake agreement, you don't have a real project. And that drove our strategy. We worked hard on that, and we had great success, I think, with Tesla and LG Chem. And the Tesla deal in particular in September 2020 was transformative for Piedmont, quadrupled our market cap, brought a lot of attention to the story, enabled us to do other things. At the end of the day, and as the markets evolved, I think if an off-taker brings something more than just a customer relationship to the table, then it's really interesting to give it consideration. If they bring funding, for example, like General Motors has with Thacker Pass, if they bring funding on an advantageous basis, that's really important. If they don't, committing yourselves longer term to a customer, while it brings a little bit of a halo to the project, it brings a little bit of complexity too. What I learned is that the customer's needs aren't necessarily, in terms of unit volume, in terms of their requirements, aren't necessarily as aligned with your shipping schedule as you'd like them to be. And every now and then, shipments you might be thinking you're going to make on a quarterly basis or whatever, customer might not need that material at the time, and you got to go find another, buyer maybe at the last minute. So it's I think these offtake relationships can sometimes add a level of complexity without necessarily any funding or pricing benefit. So in the future, where as the market evolves, it's pretty easy to sell your material directly or through a trading company at modest cost. They're far more flexible than big strategic offtakers are. So I think you'll see, in the absence of funding, I think you'll see fewer long-term offtake agreements signed by customers or by the producers.
So you mean those like evil traders at like Glencore and Trafi are actually, more your friends than Tesla and LG?
Well, there's lots of trading companies, and we I get to know the Glencore guys well, the Trafigura guys well. They're great. We developed a particularly strong relationship with one of the Japanese traders, which was very nimble, more economical, I would say. Less, they're more of a trading focus and less of a longer term investment focus, which is what some of the Swiss had thought about.
All right, and turning to, you're an American, and you navigated the Trump administration, then the Biden administration, then a little bit the tail end of the Trump too. But you had grants, and then, or loans, or I guess you had a grant, then you sought to get a loan, but you were successful at extracting some funds from the government, or at least commitments for funds. What was that like? How do you view the current, and where does that stand actually with respect to Elevra, and the projects, I guess, in Carolina?
Yeah, I don't know. I'm really out of date. I think when I left in August, we had, the grant we received was for a Tennessee conversion facility, which in a down market just wasn't a viable project. That could change potentially at some point. Maybe not in Tennessee, but I'm not saying conversion isn't viable in the U.S. But certainly in 2024, with prices falling fast, it wasn't a really good idea for us to dedicate time to that. So we gave up our grant funding. But I spent a lot of time in DC. You're right, in the late 20, kind of 17, 18, 19 period in the first Trump administration. Then with the Biden administration, a little bit of time with the new Trump administration, and with a lot of politicians. And I guess what I would say is this is very much national security is obviously a bipartisan issue. There's great agreement that reliance on China for critical minerals is a dangerous place for America to be. And it's just a question of what do you do about it? And, you talk about the Strategic Lithium Reserve as an idea. That's an interesting idea. But certainly, both administrations were quite clear that there's that direct funding a project is something they could do and would be happy to consider. And the Biden administration was particularly aggressive with loans. And the Trump administration has taken a far broader view, including taking equity stakes, which is interesting. So I think I think anybody who has something that's a near shovel-ready project in the United States in particular is in a really interesting position. And I think it's going to be interesting to see. And I haven't been to DC in 4 months, so I'm out of date on any of the conversations. But I got to believe everybody's spending time in DC, and the government's probably having a really difficult time deciding kind of where to place their bets, who the winners will be. There's some really smart people focused on it. I'm not sure who the really smart mining people are that are involved there. There's really smart funding people from Wall Street, et cetera, who are spending time. But I think the challenge is going to be for them to differentiate between projects. What's a good project? What's not? And where do they place their bets? Because in that regard, they are placing bets.
Yeah. I have some view. I was just in Washington yesterday and have been spending a lot of time talking and thinking about it in the last few months. And I think MP Materials was very unique, and rare earths, given that it is the Achilles heel in Trump's negotiations with Xi, was very, and in China, was a very particular case. So, and it's being led by the Department of War. So the equity stake that they wrote in that, I think that was just negotiated. The CEO of Cerberus had a hard negotiation with Litinsky, and you're right. But they wanted some equity. But that was very, very specific and very scarce as a producing mine, and the like. But you said if something's shovel ready, that's great. On the other hand, I see like they seem to be flooding the zone on rare earths. So anything that's rare earths, like, let's figure things out. So this company, Vulcan Elements, not to be mistaken with Vulcan Resources, which just got fully funded for lithium, but Vulcan Elements, which completed a seed round of funding only 3 months ago, or maybe a Series A of like 30 or 50 million bucks, just received an $800 million loan. Combined with their partner, ReElements, we'll flash up this deal, but I think in total the commitment was $1.1, billion, and that was very nascent, right? Very early stage, so not shovel ready necessarily. So there's not that much shovel ready. It'll be interesting to see the next cabs off the rank in lithium. Really, I think are Standard Lithium, which wants to make an FID in Q1. And maybe even before that, Ioneer, which is essentially shovel ready, but Sibanye, their joint venture partner, pulled out of that, so they're looking for like another partner there. I think those are the ones that are shovel ready, and it'll be interesting to see how the government treats those. Like, do they want equity in those, or are they just going to kind of lend money? And are they going to lend zero interest money, or is it going to be some sort of consortium of lenders? Through the Exim Bank or something like that. So it's to be seen how much they prioritize lithium, because lithium has historically been tied to EVs and renewables, which this administration is not favoring. But everything I'm hearing is that they do support batteries, and they're increasingly recognizing batteries are critical, not just for military applications, but to win the AI race. And it's not even, solar plus batteries, it's natural gas plus batteries, right? Because XAI, Elon Musk's, Memphis plant is having mega packs back up, what's otherwise natural gas powered. So, therefore, if batteries are important, the entire battery supply chain is important. So this includes cathodes and anodes and graphite, and maybe manganese, but I think lithium, I did it when I put together this Strategic Lithium Reserve note, I thought about, there are now 60 critical minerals on the list from 50 to 60. So if everything's critical, nothing's critical, how do you segment them? And I segmented them into kind of small, medium, and large, right? So small are the samariums, niobiums. Like, I don't really have an answer to those. There are certain military applications which matter. And then the big ones like copper and nickel, and, they have relatively liquid forwards markets. I don't know that the government's necessarily going to intervene with, loans or equity. They could help with permitting and they could help with 45X. But in the medium-sized categories are the rare earths, in particular, DYTB and NdPr, and lithium, and maybe high purity manganese, maybe natural graphite. These are they're not only medium sized, but they're also immature, right? You can't forward sell them, 4 or 5 years, and they don't have this long history of pricing. Like copper, you could look back 100 years. So I think it's those markets, those metals that the government should focus on and figure out tools, right, to address the massive price volatility. And those are so battery and battery materials are the ones that China is most manipulating, in addition to rare earths. So if anyone is listening from Washington to this analysis, these are where I would prioritize, and maybe the Strategic Lithium Reserve idea can be applied to other metals. But, after rare earths, I think lithium and other battery materials, but lithium, maybe graphite, are next on the priority list for this administration. And again, Standard Lithium and Ioneer were the next two. And there's also energy source minerals in the Salton Sea. They had a conditional commitment of $1.3 billion, just before Biden left office. You haven't heard very much out of the Salton Sea, although we had controlled thermal on this channel a little while ago. Anyway, last thing before we go is you talked about, Cisco and Detour, and how financing matters depending on when you finance, like what kind of markets. You, Keith, were listed on the ASX as Piedmont. One of the first things that you did was to list in the US. But for a long time, ASX had much better valuations than the US. But then in limited periods of time, the US had a better cost of capital. And I think that time is again here, right? Everybody seems to want to list in the US. And I went to this again, CSIS thing yesterday, and they were saying, all these junior miners are coming to Washington. It's great, like, to be here. It's very popular and topical. So if you could just, wearing your capital markets advisory hat, and Q2 is, listed in Canada, typically the lowest valuation across those three exchanges. The market is starting to recognize them, but they have a lot of Australian shareholders. So how do you think about that in terms of running or advising, kind of companies, where to list and what the dynamics are in the different exchanges?
Yeah, I'll get to that, Howard. I'm going to go back 1 second on the government funding, because I'm going to make my old refrain pitch for spodumene, which is I think you're right that the projects that the U.S. government will focus on are kind of American, relatively big, relatively near term. So Standard Lithium, Ioneer, obviously they're already involved at Thacker Pass. That makes sense. I support that. I think that's great. I would note nobody's ever produced lithium chemicals at scale from any of kind of those technologies. They're still pre-commercial in my opinion. And they might work really well. They might not. So if I was in DC, I'd be very focused on trying to back friendly spodumene projects, whether that's North Carolina or north of the border. And where the probability of success, the probability of being able to produce a spodumene concentrate that can go into a battery is 100%. There's really no risk to it. You take away a big element of risk. So anyway, I'm a big proponent of spodumene and think the government should think about that as well. On the listing, it really all depends. At the end of the day, as you know, we started out at Piedmont as an Australian company with an American asset. And there was a commitment from the start to redomicile to become an American company. That worked to our advantage, particularly in 2020 when we signed our offtake agreement with Tesla. Tesla obviously has been a long-time darling in the U.S. capital markets, and our stock went wild on that news. That wouldn't happen if we weren't listed in the U.S. The Australian market was far more subdued in its reaction to that news. Big discounts, 20, 30, 40% discounts between NASDAQ trading and ASX trading in our stock for several days thereafter. So the U.S. market was the place to be. It's obviously by far the biggest, deepest capital market. It's not particularly focused on mining, obviously. And in a down market like we experienced over the last couple of years, American institutions just lost all interest, and there was complete apathy. At the BMO Mining Conference, which is obviously a big one down in Florida every February, I went from 57 meetings, institutional meetings, I want to say in 2021 or 57 to 6 2 years later. Nobody cared. Nobody wanted to hear about lithium in the U.S. Whereas in Australia, everybody in Australia kept caring. And so there was certainly a period of time when the interest in Australia continued. The big institutions in Australia, big and small, are very thoughtful and knowledgeable on lithium. And mining overall, they all care, and they continue to care through the down market. So that was a good market. I don't have as much experience in Canada. Canada's a big mining market. There have been fewer lithium stories that have relied on the Canadian market for their success. Canadians like LAC and Sigma have had most of their market success in the U.S. So it really all depends. One thing I would say, anybody considering listing in a second market, particularly if it's in Australia because it's a long way away, you really need to commit yourself to be there or have a team there. You need to support the market physically. I made 25 trips to Australia in 8 years. That was really important to building the strong institutional relationships we had at Piedmont. And without that, the listing, the cross listing, I think would have been pointless. It's pretty easy when you're Canadian to be in the U.S. market because you're traveling down there all the time anyway. You're in the same time zone. There's a lot of benefit to that. So, no right answer. Something everybody should be evaluating. I'm sure the folks at Q2 are, and it makes sense.
Okay, just a final comment on two comments on things that you said there. I did have an opportunity to interact with someone from BMO yesterday who told me that all of his colleagues have had a great year in gold and precious metals and the like. In the critical minerals sphere, it wasn't so awesome of a year. But to your point about institutional interest, he said there still really isn't institutional interest in lithium and other materials. So a lot of this U.S. listing related activity has been retail generalists, especially after October, when she rattled his saber a second time on rare earths. So you get this meme stock behavior, and you could then do at the market, money raises, which may get you $100 million here or there, but to actually raise billions of dollars, the institutions are not yet focused. But maybe with all the upgrades from UBS and Barrenjoey and JP Morgan, institutions, will start to pay attention to lithium again. And then the final thing I'll say is that also there was a panel. They had someone representing UK, Canada, and Japan. And there was the Canadian woman talked about, they have a banker as their prime minister and a banker as their energy minister. And they just announced $6 billion over 26 investments in Canada. So Canada's been pretty quiet for a while, but a lot of stuff's in motion in Canada. And she said to expect a lot more to come in time for PDAC in March. So watch that space, and that could be hopefully, positive for Q2 and hopefully, and a number of the other hard rock projects that you said, because we do see in America. Yeah. And if I look at North America, I agree with you. Like you say, between hard rock, and then unconventional projects, it's less risky to do the hard rock. But in America, we don't have that many hard rock, right? We'll see what Albemarle does with Kings Mountain. But, the America does have great lithium potential, but they're all unconventional, almost all. Anyway, with that, Keith, thank you very much for joining us.
Guys, great chatting with you. Have a great holiday season.
Okay. Take care, Keith. Okay, so we just heard from Keith, but as it turns out, we were running late for our next meeting, which is with Graham Harris of Surge Battery Materials, who had recent update news. So we're going to have him chime in for 2 to 3 minutes here just with that news. But before we do that, I just want to thank again our sponsor, USCF Investments, who've been making it easier to get exposure to commodity investments for almost 20 years. USCF Sustainable Battery Metals Strategy Fund, ZSB, is designed to capture investment exposure to metals powering electrification such as lithium, cobalt, copper, nickel, aluminum, and silver. To learn more, watch our inaugural episode with CEO John Love and visit uscfinvestments.com. And thanks as well to Lithium Royalty Corp, which, as we mentioned, has a royalty on the Case Lake project of Power Metals, but also have royalties across the lithium chain, including the 3Q project operated by Zijin in Argentina. They also published good Q3 results, 86% revenue growth. To read that press release, visit their website, lithiumroyaltycorp.com, and follow them on X at lithium_royalty. So, Graham, congratulations on finalizing your joint venture with Evolution Mining, a major $30 billion gold producer listed in Australia, led by the legendary Jake Klein. So tell us about that and anything else as the year ends. Just a quick, summary of your accomplishments and what 2026 has in store.
Hey, thanks, Howard, and congrats on your white paper. It was very, very informative, and I think it was an excellent piece. And I think if you look back over the years, we talked about, it was inevitable that the government would get involved in some way, shape, or form. And I think you provide a great platform there. And it was amazing to me when I looked at that bar graph about how, that $7 billion investment would be dwarfed by, or not dwarfed, all the other investments they made in the critical mineral space would dwarf what you're suggesting. And I think it was an excellent piece you published. And I appreciate the opportunity to talk about Evolution. And I'm sitting down because I can't believe Evolution's at 30 billion now, because when I first started talking to them 2 years ago, they were a $5 billion gold company. And I think even when we referenced them recently, they were 20 billion and now they're 30 billion. So they're just steaming ahead. And I should have done nothing except put some money in there, sit back, retire, and I would have done quite fine.
Graham, we represented, RK Equity represented Evolution Mining when they just started. I mean, they started life, I think, doing this, with $150 million capital raise. And I think maybe GMP or someone, raised that. They bought their first asset. And Jake had said, the mid-tier gold producer in Australia was missing, right? Like, because I think Normandy and everything got acquired. So he set out to establish a business, probably this was 2011. So it's one thing going from 5 to 30 billion, we were there at inception, so and this is the second time he did it. He did it with Sino Gold in China. So they are now your partner, but they are not in lithium. But yeah, just tell us about the deal and what do we have in store for next year?
Yeah, I mean, you're right. I mean, they're not in lithium. They've told us, straight up that they don't want to be in lithium. But through the acquisition of the Red Lake assets and Rubicon, they had some legacy assets in Nevada, and one of them was a mineral interest in the ground right in the middle of our project. And so when I reached out to Evolution a couple of years ago, they were a little surprised to hear what they had, but they wanted to see, they didn't want to do a deal back then. Jake's a pretty wily guy and didn't want to give away the farm and do something without allowing us to explore and expand and see what's there. And then once we put the PEA out, then we could put a number to what their interest represented. And when you look at the PEA, their mineral interest represented about 23% of the resource. And that was the basis of the JV that we formed. And then to advance the project, they agreed to fund a further 10 million to earn another 9.5%. So now they're firmly our JV partners. We've established the JV, Nevada North LLC, a US-based company out in Nevada that now controls and holds 100% of the Nevada North Lithium project. And we're happy to have such a strong partner that was willing to, fund this project, because if you look back, things change very quickly in this business, as you know. 6 months ago, nobody was funding lithium. Now, and then they stepped up, and it took us about 3 to 4 months to close the deal. But now we could probably have funded alternatively. But I think in the end, consolidating the mineral resource was key, and having them as a partner is more than welcome.
That sounds great. I'm just looking at your stock chart, and you're up 78% year to date. But you did have to do a small financing, I guess, not that long ago, but like your stocks, I guess you're up 50. Where were you? You were you were 29 cents in September, right? Like, so stocks more than doubled, from that level. So 126 million Canadian market cap. So you're ending the year on a high note. How should we think about, 2026 and upside and milestones from here?
Well, I think we have more high notes ahead of us. I think now that we're funded, I mean, that's taken the overhang off the market that people say, okay, you need to get funding. Well, we've taken care of that. And now we can focus on the PFS, Howard. And that's going to be an important milestone for any junior company is, you do your PEA, your PFS. That's going to separate you from, a lot of the other companies out there. Now we're fully funded to do that. So we have a lot of news flow coming. We've got the engineering firm to hire. We've got some important people that we want to bring on board. We have, a lot of network. We're going to update the resource first quarter of next year. Based on the 9 holes that we just drilled recently. And I'm looking forward to those results, because I think it's going to give us a little bump in the overall grade. We can go into that maybe on your next podcast of why that will happen. And that's going to be important for the economics of the project. So I think next year is going to be a very important year for us as we, continue to de-risk the Nevada North project and move us up the lithium food chain to be one of the key projects that people will consider.
Sounds good. You talk about 9 holes, and I was just thinking about golf, and how I wish I were in a warmer jurisdiction than I am here in New York at present, and DC was freezing as well. So, Graham, thank you very much for the shout out on the Strategic Lithium Reserve white paper. As I mentioned, we're going to put the 5-minute video description of that on the back end just after this comment. So, thanks, Graham, for the update, and have a good holiday season and new year, and look forward to some great success in 2026.
Well, I appreciate that, Howard, as always. And, do remind yourself that, I was on here and you were telling your listeners about this story at 25 cents. So hopefully they've all had a Merry Christmas.
I hope some of our listeners have participated in that, and also do want to remind our viewers that Graham and I had a relationship with his predecessor company, Millennial Lithium, which got sold to Lithium Americas, and they are now advancing that project with Ganfeng as part of their PPG. This is Lithium Argentina now, not Lithium Americas, but success in all junior mining investments. So one thing is to bet proven jockeys and shareholder value creators. So you've already created substantial value in your first lithium company, and you're on your way to do it a second time, Graham. So it's great to see.
All right. Thanks for your support.
Welcome back to Rockstock Channel. I'm Howard Klein with RK Equity, and today I'm walking through a new policy white paper we just published, the USA Strategic Lithium Reserve, a modern SPR for the lithium age. Lithium volatility and China-controlled oversupply have stalled Western investment for years. This proposal is simple, fast, and designed to counter that dynamic directly. In the past 2 cycles, lithium prices have swung from $6,000 to $80,000, back down to $9,000, and today around 11 to 12,000. These 10 to 15 times swings would break any market, but especially one trying to build multi-billion-dollar supply chains outside China in a short period of time. And without stable incentive pricing, roughly $20,000 to $25,000 a ton, Western mines and refineries simply cannot raise financing and move into construction. The USA Strategic Lithium Reserve creates something the West doesn't have today, a counterweight to China's oversupply. It's a rules-based mechanism that, one, buys lithium carbonate, battery grade or technical grade, when oversupply pushes prices below incentive levels. And two, it releases materials during price spikes, export threats, or supply disruptions. This creates countercyclical demand that stabilizes the chemical margin, which is the real choke point, and gives private capital predictable economics to finance projects. Why lithium carbonate? Because it stores well and has a multi-year shelf life. Two, it can be converted to hydroxide anywhere. And three, and most importantly, is the clearing point for the chemical margin. If you stabilize carbonate, you stabilize the entire pricing system, from brines to hard rock to converters. It's the fulcrum of the market. To put this in perspective, a 170,000-ton reserve today, which is about 10% of global demand, would cost about $3.5 to $4 billion at today's depressed prices. By 2030, a 300,000-ton reserve would be $6 to $7.5 billion. These are single-digit billions, which are tiny compared to programs like the Loan Programs Office of $100 billion plus, or the Inflation Reduction Act of $400 billion plus, or the CHIPS Act at $50 billion plus. Yet unlike almost any other tool, the SLR works immediately. No permitting required, no 7-year construction timeline, just a stabilizing demand anchor at the moment of maximum oversupply. Importantly, the supply already exists. Chile and Argentina produce the world's largest non-China volumes of lithium carbonate. But right now, almost all of it flows to China. Redirect even a portion of that toward the U.S. and you instantly increase strategic resilience, counter oversupply, stabilize incentive pricing, and buy time for Western conversion to scale. No new mines, no new refineries, just a smarter routing of current supply. The SLR is better, faster, and cheaper than other policy tools, and can work alongside them. It's better than subsidies or price floors, which risk political blowback for picking winners. The SLR is also technology agnostic. It lets the private market decide which projects, deposits, and technologies deserve capital. And it's faster because the SLR could begin operating within months, whereas permitting mines or building conversion plan take 5 to 10 years. And finally, it's cheaper because buying carbonate at the bottom of the cycle creates a reserve that could ultimately profit taxpayers when material is released during excessive periods of $40,000 or more per ton pricing. Some may ask, why not also include spodumene? 2 reasons. First, storage and logistics. Spodumene is bulky, 94% waste, and is costly to transport and stockpile at scale. And 2, it doesn't fundamentally fix the problem. The bottleneck is not the rock. It's in the chemical conversion margin. Albemarle recently noted that even with prices rising today, the entire margin is accruing to spodumene producers, not to converters. And SQM said the same. They won't ramp their Western Australian hydroxide joint venture with West farmers until there's a conversion margin. Instead, they're just going to sell spodumene to China. The SLR stabilizes carbonate pricing at $20,000 to $25,000 a ton, which restores margin for both mining and conversion. Hard rock developers will benefit more, not less, because viable converters outside China will become real customers. The Strategic Lithium Reserve isn't anti-China. It's pro-stability. It's the fastest, fairest, and most effective way to anchor Western lithium supply chains. And frankly, it's overdue. The full Arche Equity white paper is in the link in the show notes below. If you support this idea, please share it. If you disagree, please challenge it. And if you work in the industry, please join the conversation. And yes, call your member of Congress and tell them that this belongs in the national strategy. Thanks for your attention.